Yeah, I don't think there's anything they can do to stop the price appreciation. They can try to slow it, and I mean they've been doing that for years and years. We're now at the point where the physical markets are making price as opposed to the paper markets. I mean, there's a battle going on right now, and the winner will be the physical markets, and the loser will be a collapsed and defaulted paper market structure. My guess is, how do they prevent the little guy from becoming wealthy? I think it's a pretty obvious answer is what they're going to do is they're going to put a massive tax, who knows, maybe 90% on your capital gains in gold and silver.
In today's news recap, silver plunges 4.9% after strong U.S. jobs data. The price of precious metals dropped further on Friday after data by the United States Bureau of Labor Statistics revealed that non-farm employment in the country rose in May, going above analysts' projections. The hotter-than-expected reading suggests that the labor market is still able to withstand tight monetary conditions, thus pushing prospects of a summer rate cut further away. During the reported month, the unemployment rate grew to 4%, seemingly offering a mixed picture of the country's labor market. Now we'll show you the best clips of the latest interview, but first make sure you subscribe and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
Physical markets are taking over as far as becoming the pricing mechanism. That's what's happening. There's a $30 to $50 premium in gold on the Shanghai over London, over the COMEX. And in silver, last week it got up as high as $4. So you're talking about more than a 10% premium in Shanghai versus COMEX versus London. And that is it's a slam dunk no-brainer. You buy silver in the West, you demand delivery, and you sell it and then send it for settlement in the East. So yeah, the physical markets of Shanghai, of China, those physical markets are taking the pricing mechanism away from the West. Something nobody is talking about right now is that for the last, call it 6 months or more, the amount of the debt creation in China has gone negative. And at the same time, their M1 money supply is shrinking. Understand they have a huge amount of debt also. I mean, they're also a debt problem. And I made the comment a week or 2 weeks ago that someone somewhere had better start cutting rates and easing and creating money supply, reflating, if you will. Somebody somewhere had better reflate, or this whole thing is going to come down. And I've said all along, when it comes down, it's going to be a 72-hour event. From typically Eagles were about 7% over spot, so there's been a small movement down in the premiums for gold. There's been a huge drop in premiums for silver. If we were talking a year ago, silver Eagles were $17 over spot. Now you're looking at $7 over spot. I think they got down as low as maybe $4.55. Junk silver, which was $11, $12 over spot, you can buy junk silver now for $2.50 over spot. So the premiums have collapsed, and I'm speaking now from a U.S. perspective. So I'm not speaking in Europe. I don't know where the premiums are there, but the premiums have collapsed, and I think that's a function of retail. Retail, I'm seeing less people contacting me, whether it be by phone or email or whatever, but I am seeing much larger orders. So the dollar amount may be higher, but you're not seeing the offer or inventories peppered by $5, $10, $25, $50,000 trades. Now they're 100, 250, $500,000 trades. But the retail premiums have come down, whereas from an institutional standpoint, you can see China is just gobbling up gold and India is gobbling up silver.
In today's news recap, silver price nosedives below $30 as strong US NFP report boosts US yields. Silver price plummets below the psychological support of $30 in Friday's New York session. The white metal plunges after the United States Nonfarm Payrolls report May showed that labor demand remains robust and the wage growth momentum was stronger than expected. Fresh payrolls came in higher than expectations and the prior release. Average hourly earnings rose strongly by 0.4% from the estimates of 0.3% and the former release of 0.2% on a month-on-month basis. Average hourly earnings data is a measure of wage inflation, which directs households' spendings. Annual wage inflation measure grew by 4.1%, beats the estimate of 3.9% and April's read of 4%. Strong payrolls and wage growth data prompt the need to maintain a restrictive interest rate framework by the Federal Reserve for a longer period, which is a favorable situation for yields on interest-bearing assets and the U.S. dollar. 10-year U.S. Treasury yields rally 4.43%, up by 3.5% from Thursday's close. Higher yields on interest-bearing assets increase the opportunity cost of holding an investment in non-yielding assets, such as silver. The white metal was already under pressure as People's Bank of China's gold reserves report for May showed that their 18-month-long gold buying spell paused for a while. The report showed that gold reserves were unchanged. Now we'll show you more clips of the latest interview, but first smash the subscribe button and drop a comment down below. Let's get back into the episode.
No, there's not fiscal tightening at all. I mean, if the Treasury is borrowing $1 trillion every 100 days, I mean, that's $1 trillion going into the system and being spent. Where it comes from, it basically comes from thin air. It comes from the Treasury issuing the bonds and, some market buying and a huge amount of Federal Reserve supporting the Treasury market. So from a fiscal standpoint, we're extremely loose. We're looser now than at any point in history. And I will understand the economy, and I'll talk about the United States. The real economy in the United States, I guess you could basically say exists only because the stock market is providing, if you want to call it wealth, the feel-good effect. People are still spending some money because of the stock markets, because of the financial markets. When the financial markets collapse, the United States is complete toast because we don't have any manufacturing to speak of. I mean, our manufacturing base has shrunk. Compare today to 50 years ago, we were the manufacturing king of the world. Yes. Now we don't manufacture anything. So without a robust financial market, the real economy collapses. And it used to be the other way around. It used to be that the real economy supported the financial markets and gave justification for pricing in financial markets. Now it's the other way around. Now it's the tail wagging the dog. I think it's becoming, the math is becoming too obvious. The math that these treasuries or sovereign treasuries are not going to be able to continually expand debt. The math is so obvious that now you've got well-known people talking about that problem. That problem ultimately leads to interest rates going straight up. And I say interest rates going straight up because at this point, I don't think anywhere on the planet with a sovereign treasury is there a risk-adjusted premium for the possibility of default. It's thought right as we speak now, it is believed across the world that no sovereign treasury can default. So there's no risk premium. And in my opinion, there is in the future going to be a risk premium, and that's going to cause interest rates to explode because there's more risk everywhere than anyone, you know, even contemplates. So I think it goes further than what the Ray Dalios of the world are talking about. You know, he's looking at it near term and saying, well, this is unsustainable. If you look at it longer term, yeah, it's obviously unsustainable, but that leads to a collapse in bond prices across the globe and a huge spike in interest rates, which just blows up all the existing debt. But there were three charts, gold, silver, and the HUI mining index. They all looked like they were forming a hook on the MACD. That's the moving average convergence divergence. It looked like they were crossing over at that point in time. They did cross. Silver, I think, was 28.50 in that neighborhood and ran up to 32.50. We've had a couple pullbacks. We're chopping at this morning. I think we're about 30.50, and it wouldn't surprise me to see a test of a harder test than we've already had of 30, maybe 29.75, 29.50. I do believe that you'll see that what was resistance turn out to be support from here, and it would not shock me within 3 to 6 months to see silver in a much more serious battle at the $50 level.
What do you think of Bill Holter's take? Do you agree with him? Will retail stackers get a massive tax on wealth if a debacle occurs? Post in the comment section down below your honest opinion and watch this video right here because it's a perfect fit for you. I see you on the other side.